What is the examiner trying to examine in hedging? When we're talking about the derivatives, you will have to revalue them using fair value through P&L at each and every reporting date. That is the default accounting that we're going to apply. And this means that we are going to have impact on our profits, earnings per share before the cash transaction happens. When we apply hedging, whether it's fair value hedge or cash flow hedge, we hide this P&L effect, and as such, we don't have any effect on earnings per shares before the actual transaction happens, which is actually in line with whatever we try to do. We tried to hedge the transaction, we tried to reduce our risks, and as such, it's not very relevant to the users of the decisions to show the original transaction and the effect of hedging in different periods. And the way that we're going to be tested, the reason why we're tested on hedging, is actually the desire of the companies to manipulate the accounts and hide bad fluctuations in fair value hedge or cash flow hedge, where they can't do that. So first of all, we need to know the effectiveness criteria. So for example, you can't use hedge accounting if economic relationships are not closely related between a hedging instrument and a hedged item. So you can't, let's say, hedge gold using, let's say, the prices of silver. Despite the fact that precious materials sometimes follow similar pattern, the risks are going to be very different. But, for example, when we're talking about the materials and the final product, like, let's say, petrol and the cost of crude oil, they are going to be closely related, most likely, and as such, we can use the futures for crude oil to hedge the price of petroleum. Now, in our case, we will have to challenge the economic relationship. We will also have to look at, let's say, whether it's a derivative in the first place or not, like whether it's executory contract or not. So, for example, if, let's say, the transaction is to actually receive gold, we can't use hedging, we can't actually account for it using the derivative mechanism. When applying effectiveness criteria, we will also look at whether the company actually tries to hedge it or it tries to win on the market fluctuations. So, for example, if you bought futures on gold and you have nothing to do with gold, then there is no hedging. And if you bought futures on gold because you are going to buy or sell gold or use it in production, then yes, okay, you can apply hedging if other criteria are met as well. With the hedging, of course, you will need to know how to account for that. And when we're talking about the fair value hedge, it's quite tricky because we're going to hide the effect of the derivative revaluation into the value of the asset or liability that you have on the balance sheet, which is your hedged item. And the problem in here is when you try to hedge your inventory. Why? Because you need not to forget to talk about IS2, net realizable value test. So, for example, if you have gold as inventory and you bought a derivative, you sold the derivative, doesn't really matter what it would be in terms of advanced financial management. With the SBR, we don't care about it. We always use the word bought. So if you bought a derivative in order to hedge this very price of gold, then in this very case, you will need to think about whether you should apply net realizable value test or not, and you will have to say that you shouldn't, because it can't be applied to a part of fair value hedge. If you were to have cash flow hedge, in this very case, you would have to apply net realizable value to the inventory because it's now not a hedged item. The hedged item is going to be your future transaction, so the future sale of inventory, the future cash flows that you're going to get for the inventory. Another thing is the effect on cash effectiveness on how much you can recognize in OCI. When we're talking about the cash flow hedge, by default, we are going to put the difference, the revaluation of the derivative that is used as hedging instrument to OCI. But the excess of the change in the derivative, the change over the change of the fair value of hedged item, will have to go to P&L regardless whether it's income or expense. That is what you need not to forget. When we're talking about the fair value hedge, please remember that if fair value hedge is used for something that is valued using fair value through OCI, then we're going to use OCI there and not P&L. It can be that we will have hedge ratios or rebalancing, and the idea of that is if you have a stock full of warehouse full of gold, for example, you can't buy just one futures in order to hedge this very gold. You can't say, I bought one futures, now I'm not going to apply net realizable value test. No, it's not how it's working, and as such, you will need to talk about the hedge ratios, but that is not tested regularly. You can try to attempt question Carl, and that showed you how to recalculate the ratio, but frankly speaking, it's not doesn't happen that very often. And that is it. That is something that you need to look out for when we're talking about hedging. And those of you who are my students, make sure that you watch the video where I talk about derivatives, fair value hedge and cash flow hedge, and show you what is going to be day by day, date by day, period by period, because it will help you to visualize the process. And I will see you next.